As the U.S. markets are closed for the weekend, Nuburu Inc., trading under the ticker BURU, last finished its session on Friday, November 7, 2025, at a price of $0.2804. This was a gain of 3.55% on the day, but that simple figure hides the extreme volatility of the session, which saw the stock trade in a wide range between $0.2435 and its closing high. This stock, with a 52-week range swinging from just 12 cents to nearly $1, is a battleground. And what many investors fail to see is that the company they thought they were investing in, a pure play on industrial blue lasers, is rapidly transforming into something else entirely right before their eyes. The common belief, the story that likely drew many to this stock, is centered on Nuburu's proprietary blue laser technology. The expectation is that this technology is a key enabler for the future of manufacturing, especially in welding conductive materials like copper, which is critical for electric vehicle batteries and the broader e-mobility supply chain. This narrative paints a picture of a high-growth, disruptive hardware company poised to ride a massive industrial trend. But the reality of the company's recent actions and the stock's behavior tells a much more complicated and urgent story. The flurry of press releases in October and November isn't about new laser contracts. It's about a complete and radical pivot into the defense and security industry, including the acquisition of a software-as-a-service company. This isn't a simple expansion, it's a transformation plan. And the market is struggling to decide if this is a sign of brilliant foresight or a desperate act of survival. Let's look at the recent trading. The stock is down nearly 30% in the last 2 weeks alone, despite the 3.5% pop on Friday. That end-of-week gain came on staggering volume, with over 55 million shares changing hands, a massive figure for a company with a market cap of less than $40 million. This isn't calm, considered investing. This is high-speed speculation. We saw the pressure earlier in the week with a nearly 8% drop on November 4th. This volatility is being directly fueled by the company's own announcements. On October 13th, the stock was hit with a YNSE American warning letter regarding disclosure compliance, a significant red flag. They resolved that by October 16th, but the damage to confidence was done. Then, on October 22nd, the company announced a strategic alliance with Maddox Defense for drone technologies, causing a 25% surge in pre-market trading. Just over a week later, on October 31st, they announced the completion of the first phase of acquiring Orbit SRL, an Italian SaaS company. And just this past week, on November 6th, another release about strengthening the balance sheet and advancing this new defense tech program. This rapid-fire string of news is the crux of the bull versus bear debate. The company is fundamentally changing its business model. But why? The financial data suggests the original plan was not working. The company is deeply unprofitable, with a trailing 12-month earnings per share of negative $2.22. More worrying, revenues from its core laser business have been declining at an average rate of nearly 40% per year. When you have a technology that is supposedly revolutionary, you expect to see accelerating revenue, not a steep decline. This financial reality is what underpins the entire short-selling argument. This brings us to the immense pressure the stock is under. The official short interest, as reported by the NYSE, stands at over 26% of the public float. This is an exceptionally high number. It signifies that a large and likely sophisticated group of traders is betting heavily that the stock's price will fall. The core of their thesis is simple. Nuburu is a company with declining revenues in its primary business, is burning through cash at an unsustainable rate, and is now attempting a highly speculative, capital-intensive pivot into an entirely new industry. The short thesis is a bet that the company's cash runs out or that it will be forced to dilute existing shareholders into oblivion before this new defense plan ever has a chance to generate meaningful profit. We've already seen a warning sign of this with a major risk of shareholder dilution noted in financial filings in late October. The company must raise cash to fund these acquisitions and new operations, and with the stock price this low, the most likely way to do that is by selling millions of new shares, making every existing share worth less. Now, many retail investors see a high short interest number like 26% and immediately think of a short squeeze. This is where a deeper understanding is critical. Looking at the data on a platform like Fintel, we can see the days to cover is just 0.40. This means, given the stock's massive daily volume, all short sellers could theoretically buy back their shares and close their positions in less than half a single trading day. This is the opposite of a classic squeeze setup where a low-volume stock traps shorters. Here, the shorts have plenty of liquidity to exit. What we also see from off-exchange data from FINRA is the short volume ratio is consistently enormous, often accounting for 50 to 60% of the daily trades. This isn't a squeeze play, it's an active, high-volume battle. The borrow fee, the rate short sellers pay to borrow shares, has been hovering around 8%. This is significantly higher than a normal stock, showing a consistent demand to short, but it's not the 100% plus rate you see in a full-blown squeeze mania. Investors can track these bi-monthly short interest reports from the NYSE and monitor borrow rates on financial platforms to see if this pressure is increasing or fading. What's your read on the 26% short interest? Is it smart money identifying a sinking ship, or is it suppressive pressure on a company trying to transform? Further complicating the picture for long-term holders is the institutional ownership, or more accurately, the lack thereof. According to recent filings, institutional ownership is less than 1%. We are talking about a handful of funds holding a total of around 735,000 shares. This is not a stock that big money funds are buying. This is almost a purely retail-driven stock, which explains the extreme reactions to news and the kind of chatter you see on investing forums with people asking, when will it hit $1, while others post, this is a pump and dump, 99% down. The reality is, with almost no institutional foundation, the stock price is subject to the wild swings of day traders and retail sentiment, making it an incredibly high-risk proposition. The company's future is not in the hands of long-term pension funds, but in the day-to-day flow of speculative capital. So, let's establish what Nuburu is becoming. The original story of blue lasers for EVs is now just part of the pitch. The new company, via Nuburu Defense LLC, is an aspiring defense contractor. The acquisition of Orbit SRL is meant to give them a foothold in the multi-billion-dollar operational resilience and crisis management software market. The joint venture with Maddox Defense is aimed at drone technologies. The company is trying to build a hybrid platform of hardware, lasers and drones, and high-margin software, SaaS, to sell to governments and defense agencies. This is an ambitious plan, but it's also one that puts them in direct competition with established multi-billion-dollar defense giants, all while Nuburu has a market cap smaller than a rounding error for those competitors and a balance sheet under constant stress. Looking ahead, the future of Nuburu rests on one thing: execution of this pivot and its ability to fund it. The next earnings report will be a critical event. The market will no longer care about small laser sales. Investors will need to see hard evidence that this defense strategy is working. Are they announcing new government contracts? Are the Orbit SaaS platform being integrated and cross-sold? And most importantly, what is the cash burn? How much new capital did they raise, and how many shares did they have to issue to get it? The primary risk here is not that the blue laser technology is bad. The primary risk is dilution. The risk is that in the process of funding this transformation, the company issues hundreds of millions of new shares, permanently keeping the stock price in the sub-dollar range, even if the business itself eventually finds its footing. Comment below with your take on this defense pivot. Is it a brilliant strategic move or a desperate last-ditch effort? In the end, we are left with a stark contrast between expectation and reality. The expectation for many was a simple, high-growth technology stock that would revolutionize manufacturing. The reality is a deeply unprofitable microcap company with declining revenues in its legacy business that is now attempting a complete high-risk transformation into a defense SaaS hybrid. It is doing this while fighting a 26% short interest and being almost entirely ignored by institutional investors. The stock's future will be a tug-of-war between the company's ambitious press releases and the harsh financial reality of its cash burn and the ever-present threat of dilution.